Every retail trader has faced this. Your trade is in the right direction, your setup is clean, but your stop loss gets hit perfectly right before price takes off where you thought it would. That's not coincidence, it's calculated. What you're witnessing is the market's hidden mechanism called liquidity hunting. Smart money isn't trading like you. They're trading against you by targeting your stop losses and using them to fill their large orders. In this video, we're going to break down what liquidity pools are, how they're used by institutions, and how you can trade in their footsteps using real-world charts. Let's decode the trap. A liquidity pool is not just a zone, it's a collection of pending orders. Think of stop losses, pending buy-sell limits, and breakout orders. These pools often form at obvious price levels: double bottoms, double tops, swing highs, and lows. Market makers need these zones because they provide the volume necessary to execute large orders without causing major slippage. In the ICT style diagram shown here, price approaches an old low and taps into a clearly marked liquidity pool. It's not about price just breaking support. It's about triggering sell orders so institutions can buy into that selling pressure, giving them fuel for the rally that follows. To understand smart money movements, you must know the difference between internal and external liquidity. Internal liquidity exists within a current structure, the mini highs and lows inside a range. It's used for intraday manipulation. External liquidity lies beyond the boundaries above major highs and below significant lows. These areas are packed with retail stops. The chart here outlines how price moves through internal liquidity first to build momentum, then launches outside the range to harvest external liquidity before reversing. This behavior is consistent, predictable, and weaponized by smart traders. Price doesn't move randomly, it moves toward liquidity. Think of it like gravity. Large players can't just buy anytime they need someone on the other side selling. So what do? They look for a cluster of pending sell orders, a sell-side liquidity pool, and push price into it. Once they've filled their large buy orders, price takes off. The image you're seeing is the perfect example. Notice how the price dips just enough to clear those lows and then rockets upward. That's not volatility. That's smart money refueling for the next leg. This is where most traders lose money: false breakouts. You see a candle close above resistance, you enter long, but price reverses hard. Why? Because your breakout entry adds liquidity. Institutions use that volume to execute short positions. In this live chart, the red zone marks an order block, a previous area of heavy institutional selling. When price spikes into it, many retail traders enter thinking it's a breakout. But it's a trap. Notice the aggressive rejection afterward. That rejection wasn't just resistance, it was smart money offloading positions. During consolidation, liquidity builds on both sides of the range. These zones are extremely attractive for institutions. In this price action study, you'll see how the market ranges between two boundaries, forming equal highs and equal lows. These are not just structure, they're liquidity magnets. The moment enough orders accumulate, price breaks out, sweeps the pool, and then reverses sharply. This confirms one thing: price doesn't break out to continue, it breaks out to collect. Only after a clean sweep does the true direction reveal itself. Think about this logically. Large institutions need massive volume to open or close trades, but the average market has limited liquidity. So how do they make sure their orders get filled without moving the market too much? They create fake price moves, pump it up or dump it down just enough to hit retail stop losses. Your stop loss is not a mistake, it's their target. The moment they trigger enough stops, the opposite move begins. The price didn't change direction for no reason. It changed because the big players got what they needed. The ICT method is centered around one idea: let the market do the manipulation first, then take your position. ICT traders mark old highs and lows, identify liquidity zones, and wait for price to sweep them. Only after that do they look for confirmation. The chart here shows a perfect sweep of an old low, a liquidity grab, followed by a bullish engulfing candle. That's the confirmation. Instead of predicting, you're reacting to smart money's footprints. This makes your entries low risk and high probability. Let's put this into a strategy. First, identify clear highs and lows, preferably with equal points that scream retail trap. Mark those zones as liquidity targets. Then wait for a sweeper wick that breaks those levels without continuation. Enter once price comes back inside the range that's called a reclaim entry. Your stop loss goes just beyond the wick. Target the next liquidity zone in the opposite direction. This is how you follow smart money, not guess against it. This method flips your stop loss from a target to a weapon. Here's the truth. Most retail traders unknowingly provide liquidity to the market. Every time you chase breakouts or set obvious stops, you become the exit liquidity for smarter traders. But when you learn to recognize liquidity pools, understand internal versus external zones, and wait for manipulative moves, you flip the game in your favor. This video wasn't about a strategy, it was about a mindset shift. Subscribe to Financial Freedom FX if you're ready to trade like smart money. And remember, don't feed the pool, drain it.